This podcast is for general information only. If you're after advice for your own situation, it's best you chat with a licensed financial advisor.
Welcome to the Aurellan Asset Management Intergenerational Thinking Podcast. My name's Rachel Weld and I am Investment Principal at Aurellan. When we designed the Aurellan Global Shares Fund, we wanted to bring the world's best global equity managers to New Zealand and partnered with US firm Wilshire to help us identify these managers. Our global fund is constructed to be style neutral and we currently have 3 underlying managers of the fund. Loomis Sales, which is a growth manager, LA Capital, which is a quant manager, and Causeway Capital is a value manager. Today on the podcast, I'm very excited to introduce Sarah Ketterer, who is CEO, co-founder and portfolio manager of Causeway Capital. Welcome, Sarah.
Thank you. Glad to be here.
So, Sarah, what led you to get into investing and start the Causeway Capital business?
Well, I was really lucky that my father was in asset management. He had started his own equity firm, albeit he'd worked for several others prior to that. And I'd never seen anybody work so hard. He would drive off at Saturday mornings, a car full of research. Everything was paper back then. Sometimes some of it was fly out the window and I'd run after him. But he must have loved it, I thought. And I paid then little no attention, went through graduate school of business and went off to investment banking. And then I had a chance to start a database firm and didn't quite know what to do with it. What do you do with all that financial data? So I rang him up and said, do you want to buy any of it? And he and his business partner invited me to come in and do some consulting. And they said they were thinking about starting international equity. And this was a very long time ago. And it seemed like a great opportunity. I was 29 years old. Why not? And that I got bitten by the bug. If you really love to invest, it's something you know from an early stage in your life. And it doesn't matter what era. It doesn't matter that I'm a fossil today in the asset management world. It could be true today. There's something about investing, doing the research and thinking about and I don't mean trading. I really mean investing, where you're assessing the value and where is the opportunity? How can I realize it? And when you have these wins, you're ecstatic. And when you have the losses, they don't drag you down to where you can't function. You have to be able to put those aside and focus. You just need to get more than half right. And as long as you can do that on a sustained basis, you have a real gift. And that's why I've enjoyed doing this. Is I loved it in the whole world of investing and then finding people who also were bit by that bug. And they too are consummate investors. You have to be like that. That insatiable curiosity has to be embedded in a person indefinitely in order to want to do this job, at least from a fundamental perspective, because there are always questions that are unanswered, and seeking those answers is so important. So that's what got me into the business. And then the chance when the firm I was working for was going to be sold to start our own firm, which was terrifying and wonderful and exhilarating and horrifying, all wrapped up into one. We lost money for 3 years, and my business partner, Harry Hartford, and I loaned the business money to keep it going. We had 24 employees, and then as if it's like my analogy would be the kite that finally catches the wind and doesn't fall to the ground. We went right up, and after 3 years, clients wanted to hire us. We were at the beginning of a great wave of value investing in the early 2000s. So our timing was good, and that gave us the flexibility to do a lot more and think about other strategies and how to make sure the business was well positioned to succeed in the future.
And I understand, even though your father was a value investor, he didn't help you at all to start up your own firm.
Yeah, you did your research. Yes, other than kind words, that was it.
Wow. It's very impressive what you've achieved. So Causeway value funds have performed very, very well. What does it mean to be a value investor, and how does your investment process capture the best investment opportunities?
This is a fascinating question because it's evolved. I would have answered this differently 25 years ago. I would have said that we buy inexpensive stocks and the market doesn't understand the business, or something about the business is cycled down. But it's much more complicated today because there are, as you know, there are indices that replicate supposedly the value investment factor or style, and yet our understanding of value has become demonstrably more sophisticated, particularly during that tough period when, as I mentioned, when interest rates were zero or negative. That created an environment where we had to think much more carefully about how to identify undervaluation that is going to be realized by the market and isn't necessarily captured in obviously cheap characteristics like low price to book value or low PE ratio. And that has led to an evolution of our team where we're extremely opportunistic. And I talked about intrinsic value, this idea that a stock is worth the present value of all the cash it can generate into the future, discounted to present. And again, we need a discount rate. It can't be zero. But what is that stream of cash flow, and how can we have some influence over it? And that's the big difference. So I think of what we do in value, at least in our fundamental international and global strategies and funds, as active value. And what I mean by active is we're actively participating, interacting with management teams, holding those management teams accountable for improved top line growth, margin expansion where we can get it, and ultimately the cash that gets returned to shareholders, and seeing that cash flow accelerate. So this isn't about cheap stocks. And the final point I'd make is sometimes a very cyclical company, one that it's under earning, meaning the company isn't earning much because they're out of favor, their cycle is turned down, could be the economic cycle where they operate is weak. That means that they're likely to be trading on fairly high multiples. They're going to look expensive on the surface of it, but in fact, when earnings recover, those multiples are actually very low. So understanding where a company is in its business cycle has become much more important, and our ability to look forward and project our expectation of the business and how it will resume growth has been central to our success.
Does it concern you, the weight of money that's flowing into index and passive funds?
I'm not concerned by it. To some degree, it creates opportunities. I think of these, you can almost hear the hooves. There's a stampede often into different parts of the market. I mean, today as we speak in early March of 2026, the stampede is into energy stocks and utilities, leaving much of the rest of the markets globally very out of favor. And we saw for the last several years prior, stampedes into technology stocks. Where there's an irrational valuation is the opportunity for those who are using valuation as a primary stock selection tool.
So given equity market valuations are at all-time highs, where are you seeing the best value opportunities at the moment?
Well, I would have answered that question differently a week ago, but now that we have had some waves of fear wash over markets, and in fact, before we've had geopolitical turmoil, just in the weeks prior to that, let's isolate 2026, markets are very concerned about AI disruption, and in particular, software. And we normally can't buy a lot of software stocks. The software companies traditionally are extremely high margin. They're very profitable, and they don't necessarily lend themselves to a value approach. But now we can have any we like. And it's so interesting to see the market psychology dump an entire area that was very, very expensive. So within enterprise software, there are companies that are falling into our net that we're looking at carefully. And then we too have to gauge whether or not these businesses are going to be disrupted, undermined. I don't mean put out of business, just the terminal growth rate. What is this business how should it grow into perpetuity? That may be lower because of AI, and it's up to us to determine whether or not that's the case. So that was an interesting area before geopolitical turmoil. And now I'd say our scope has widened to just about everywhere outside of the two popular areas, energy and utilities. There are always a few exceptions here and there. But think of, at least from a fundamental perspective, we want to be where others are not.
So can you maybe pick a stock that you're excited about and run us through how that stock gets on your screen and where it becomes an ultimate part of the portfolio?
Well, let me give you a software example, one that had been riding high, and we held it for some years and took quite a bit of profit in it, but has now been punished. And this is SAP, the German-listed enterprise software company. Its market capitalization is somewhere in US dollar terms around $235 billion. So it's not a Leviathan, and the market is treating this company like it might not survive. And we think of this business as very sticky, very mission critical. This company's software is so integral to its various clients that we call it system of record. There's too much of the company's own processes and way of doing things built in that it would be very hard for AI agents to replace it. We think that some of the agent activity will be built on top of SAP's software, which should actually make what SAP provides even more valuable. But we're always very conservative in our valuation approaches, and we're looking at this company. We think it should trade at maybe high teens price earnings multiples, and right now it looks as if the company's trading in the mid-teens on next fiscal year. So there's quite a bit of room for a re-rating, even on our very conservative outlook. We actually use a discounted cash flow to value it. We like the management, both the CEO and the CFO are excellent. And we haven't given in evaluation, we haven't given any benefit for progress in their business data cloud. So this is where we expect them to see more customer interest and more ability for them to charge fees. And in order for companies to use AI effectively, they'll need data analysis and warehousing of data on an SAP platform. So this is a company, the reason why we just like it, we like it quite a bit, is that they'd be very difficult to dislodge. They can't overly abuse that position, but as long as they are providing value to their customers, we think they're going to be in quite good shape. But the market disagrees with us. And to your point about indexing, I think all these software stocks have kind of been sold off with the exits from software-related indices.
So is that a holding you've had in the portfolio for a while, or is it one that you've recently added?
We've had it for probably 4 years, and it arrived in the portfolio because it was trading at a discount to its US peer Oracle. And our thought was, well, they shouldn't. They're a little later to transition their clients from on-premises to cloud, but all of that latent revenue was coming. And we like the new CEO. When you see somebody effective in the top job, it's often an encouraging sign that the strategy will be implemented and the earnings growth will occur. So the winds were shifting in the right direction. The screen, if you think about it, screens, we have quantitative screens to sift through thousands of stocks globally, but they're just one of what I think are several different ways of identifying investment opportunities. And others are very experienced portfolio managers and analysts who are accustomed to looking at sectors globally, and they know what they'd want to buy if the price were right. So there's that kind of concept of the stock falling into a net, or they're looking for slip-ups where a great business could be in one that has few competitors, like an oligopoly or any type of competitive moat that can't easily be pierced. And again, SAP is in that category. And what if the market again becomes overly pessimistic? That's our chance to move in and build a position. And maybe the third category is just seeing a business that's continuously underperforming, but could be great assets, or it has something that with better management could be exploited, and that would lead to an improvement for shareholders. So the screens are in part knowledge and experience combined with some more mechanical quantitative sifting through stocks looking for certain criteria.
And how about the portfolio construction? How do you determine the weights of the stocks and ensure that the portfolio is diversified?
Well, from an international and global perspective, we get all the stocks on a level playing field and compare them over the same time horizon. That's a huge accomplishment, and we drive all of our research to that goal, which is setting a 2-year price target for every stock that we consider to be a candidate for client portfolios. And then we risk adjust using our quantitative multi-factor risk model. We added the risk adjustment is the incremental amount of prospective volatility that stock should add to the portfolio if we were to buy it and then use up cash. And the two together, the total return, the difference between the current price and the 2-year price, our 2-year price target, any income the stock offers, typically in dividends, and then risk adjusting it so that we're comparing stocks that they don't concentrate risks in the portfolio. That's been very helpful to us so that we can rank all the candidates we have for client portfolios in our funds from highest risk-adjusted return to lowest. And the stocks that are the highest risk-adjusted return are typically the largest weights in our client portfolios. They're the ones we emphasize. And as stocks drift down the ranking because the returns aren't high enough to overcome their risk, those get low weights or no weight, depending on where they are versus the other candidates. So think about it as, rather than something political or having a wizard CIO allocating to different stocks, we let the stocks fight it out amongst themselves. This is a bottom-up process in our international and global equity.
And it sounds like it's benchmark unaware.
Yes, we're aware, but we are unconstrained.
Unconstrained by the
very aware.
You mentioned the big tech, and people are comparing it to the tech bubble of the early 2000s. As someone who's seen both, how do you view markets today versus back then?
Definitely, I will refer to the U.S. market where that's where the tech action really is located, and it's much more concentrated. The top 10 in the U.S., top 10 stocks make up somewhere over 40% of the total market, and that was more like 27% in March of 2000. And then from a valuation perspective, just taking simple price earnings ratios, 1 year forward, they were like, per memory, something like 70 times in the tech sector to 80 times in 2000, just jaw-dropping. And now they're more like 30 to 40, which is still very high. It's just not absurd. I mean, that's a subjective answer. And then I would say most of those dot-coms back in the early 2000s were unprofitable. And yet the Leviathans, the big stocks in the U.S. market, are profitable. They have big margins. They have so much cash flow, they can spend it in a just extraordinary fashion in order to fund the data center expansion they need. So it's different and looks less bubbly, but the bets are clearly right in front of our faces, which is the adoption of of AI tools and the ability of these large companies to monetize what they're doing in AI, not just with the consumer, but in particular with enterprises, is critical in order for them to see a return on all this massive spending. Something like $700 billion this year in CapEx alone from what is effectively a handful of companies.
Yeah, it's amazing. I noticed that Causeway Capital is majority owned by women and minorities. Mm-hmm. Is that something that's simply a result of your shareholding, or is it a strategic initiative?
It isn't a strategic initiative. It is a result. But we've attempted to bolster it because at some point in time, the senior generation, of which I'm one, will move on to whatever we do next. It's probably, for me, visits to New Zealand. And we need a pipeline. And the reason why we need more women and minorities in the pipeline is that type of diversity brings different thinking. And that's what our clients expect, is that we're not homogeneous in how we think, but rather different and diverse opinions come to the table. And I have seen it. I think the different people have different risk characteristics. So their alacrity toward investing, their ability to channel intuition. Some of this is becoming even more important in an AI world where information will be accessed while we're all sleeping and synthesized and summarized and delivered. It won't be that you were able to read the 10Q any faster than anybody else. It'll be because in that filing, whatever the summary was, you just looked at it differently. And so that's a long-winded saying, although we have the structure we have by just by the nature of the history of our organization, I'd like to perpetuate it just to ensure that diverse thinking continues.
Yep. There's still a underrepresentation of females in this industry, though, isn't there?
There is. There definitely is. And the best we can do is to seek pipelines and make sure that young women are attracted to the industry, get started, and realize it can be very lifestyle friendly if unlike many other areas in finance, which I don't think are. So asset management has a real edge in that respect. And there's so much more to this business than just the numbers. You need to have the ability to understand and anticipate and read people. Because at least from a fundamental perspective, we are making discretionary decisions day in and day out. And a very linear, rational approach isn't enough. The whole package is humility and endless curiosity and a way of looking at the companies and their industries or sectors, the world differently than most others.
So Causeway Capital's been going for 25 years now. What have you done to ensure that the business is going to be successful in the next 25 years?
Well, aside from prayer, I'd say it's staffing. It's getting the right people in the right seats and making sure that they're well trained. And we have 6 fundamental portfolio managers who are shoot the lights out capable. And then we have a couple of associate portfolio managers in international global who are excellent, who could step into the senior shoes at any moment. And then we have we've got 4, and I would say a half, excellent quantitative portfolio managers. One of them is more junior than the other 4, but they're extremely capable. And then we have senior analysts who are rising up, who could become portfolio managers one day or are just phenomenal senior analysts and highly valued in what they do. So that to me is, there isn't anything more important than ensuring that the investment team is motivated, focused, has the tools they need, really enjoy their work and each other, and then have all the infrastructure around them to ensure their success, the administrative and in particular technology.
Yeah, that's it. Work enjoyment is very important, isn't it? And Causeway Capital is 100% owned by the employees?
We are, and one former employee who sits on our board. So we determine our own destiny. And I can tell you, I think you asked for the next 25 years. That's quite a long time. I suspect we'll control our own destiny 25 years from now as well, because once it becomes part of the culture, once you are, it's a risk-taking mentality. We have no one to blame if we make mistakes, but we don't report to anyone. We are our own masters.
Great. Now we come to the segment of the podcast where we ask our guests a few questions about themselves. What might people not know about you?
Well, I think people don't know me well at all, which is kind of my fault. I should probably make myself more accessible. But I like to explore, and most people don't know that. I think they just think I like to work. But I could go somewhere no one has been, or I could hear something no one has heard yet. It's the newness of it that I find exciting. And maybe someday when I have more time, I'll do more of that.
Mm-hmm. That's what makes you good at your job.
Yeah.
What's one lesson that you've learned the hard way?
Gaining consensus amongst my colleagues. And even though I may be convinced that I'm on the right track, it doesn't really matter. Without consensus in a people organization, the prospect of achieving whatever it is I wanted to do is impossible. And I have tried it both ways, and I can assure you that gaining consensus amongst those who care about whatever the subject is makes a huge difference. Everybody's then, they got a stake in the decision, they're embracing the idea, and its likelihood of working is much enhanced. But I did make lots of mistakes. You could fill it, well, I don't know what the container would be, but it would be large.
So what's a book or a podcast that you've recently listened to and enjoyed?
Well, I read insatiably. I love to read. And because I'm on the move so much, I often listen to books now. It's not that I'm a lazy reader. I just get multitasking. But I switch back and forth. Like I finished, it was a recommendation, so I didn't come up with the idea. But the World I See, which was Fei-Fei Li, the Stanford brilliant AI scientist, about her life and how she ended up as an immigrant in this country, and her incredible academic success and her curiosity and how it perpetuates to this day. That one was great. But on the back of that, because I have to give you one more, I read a book by James Nestor called Breath. And it's about breathing. And I never think about breathing. I didn't know you were supposed to think about breathing. But it's fascinating and complementary to everything we do as humans.
Oh, I might look that one up. So tea, coffee, or something stronger? Or all of the above?
Oh, well, it depends on the season. But I will drink a lot of tea in the winter. And nice, strong tea, very English tea with a bit of milk in it. But in the rest of the year, it's coffee. And I seem to be able to, before 11 o'clock in the morning, take in enormous quantities of caffeine and function just fine and sleep as well. So whatever that gene is, I'm glad to have it.
Oh, nice. Oh, well, thank you so much, Sarah, for your time today. It's been great to talk to you. You've been very insightful. And we at Aurellan are very excited to have you as one of our underlying equity managers.
Well, thank you for inviting me. I much appreciate it.
And we hope to see you in New Zealand again in the not too distant future.
Oh, my goodness. Top of my list, places to go.
Yeah. Yes. Thanks again, Sarah. I hope you enjoyed this podcast. If you'd like to learn more about Aurellan, you can look for us on our website, aurellan.com, or follow us on LinkedIn.
Thanks for listening to the Aurellan podcast. Everything we've shared is general information only, not financial advice. If you'd like guidance in your own situation, please talk to a licensed financial advisor.